Welcome to a new era of personalized investing, where private investors understand that true value lies beyond mere relative performance. Amity recognizes that investing is a deeply personal journey, and success is not just about numbers. Discover a refreshing approach to investing that prioritizes clients' goals and well-being. Unlike ordinary investment options, we are dedicated to a true outcomes-based strategy, bringing certainty to investment outcomes. Don't settle for the ordinary. Embrace the future of predictability and certainty with our outcomes-based investment approach. At Amity, we believe in delivering personalized solutions crafted specifically for advisors' clients, understanding their risk appetite, goals, and preferences. Join us now and unlock the potential of a more rewarding and fulfilling investment experience that goes beyond the mere performance and places the client and their aspirations at the center of everything we do. Reduce uncertainty with outcomes-based investing. Amity Investment Solutions.
2023 has been yet another interesting year. Perhaps the most interesting headline to date was this: excruciating prices and limited egg supplies. Well done for the wordplay. But what an interesting dynamic. Economics taught us a lot about supply and demand pressures, but to truly experience irrational, panic buying, inflationary pressure is quite unique. And who would have guessed eggs would become such an in-demand commodity? But the idea behind sharing this little story this morning is the inflationary pressure that we have experienced, not just locally, but globally. Now, back in January this year, the World Economic Forum listed the following as manifesting risks. Now, in the same article, the World Economic Forum also stated that ranked as the most severe global risk over the next 2 years by Global Risk Perception Survey respondents is the global cost of living. And the crisis is already here, with inflationary pressures disproportionately hitting those that can afford it the least. And how true it has been this year. Now, terms such as shrinkflation, greedflation, skimflation is now much more acceptable. Shrinkflation refers to paying the same for your slab of chocolate, but not noticing that it is now 75 grams and not 85 grams. And where skimp inflation refers to paying the same or even more in restaurants, but realizing there's a lot more garnish on your plates and a lot less chips. You see, South Africa's annual inflation rate has accelerated for the second successive month to 5.4% in September 2023, up from 4.8% in August, and it's slightly above market forecasts of 5.3%. It is, however, within the targeted band, but may I remind you that our 3 to 6% target band has been under review before. Back in 2004, we were meant to move from this 3% to 6% target band to a 3% to 5% target band, and then further down to eventually get to a target band of between 2 and 4%. But in 2001, the Argentine crisis caused us to pause a bit, and then this rand started to depreciate substantially. Now, our core inflation, now this excludes your energy, your food, your fuel, etc., that part of the inflation eased to a 13-month low. And though inflation is expected in the fourth quarter to maybe end at around 5.9%, we are cognizant over some elements that will potentially put pressure on inflation going into the new year. Medical aids have all announced their increase for 2024, and a family of 4 could potentially see an average increase in their budget monthly of 550 Rand going towards medical aid premiums. Then there's the increase in oil prices, a weaker rand, and that all adds to pricing pressure as well. At our last MPC meeting, we saw the committee somewhat divided, and not all members were in favor of keeping rates unchanged. The US economy expanded at a remarkable strong pace in the third quarter. Now, despite interest rates at their highest level in 22 years, not only have US consumers continued to open their wallets, but other parts of the economy are also displaying some resilience. Now, residential fixed investments, which reflects the conditions in the housing market, has advanced at 3.9% annualized rates in the third quarter. And the recent GDP report showed something very interesting. It's the first time that this component contributed to growth in more than 2 years. Now, the third quarter GDP report also showed that business spending, known as your non-residential fixed investment, declined in the third quarter, and inventories and federal government outlays also contributed to growth in the third quarter. That expectation bodes well for the Federal Reserve, which has raised interest rates 11 times since March 2022 to slow the economy and to defeat inflation. Now, the Fed Chair, Jeremy Powell, has said the US Central Bank needs to see below trend growth to be assured that inflation is on track to slow to 2%. So-called core inflation, measured by the Fed's preferred inflation gauge that strips out your volatile food and energy prices, rose 3.9% in August from a year earlier. That is down from a peak of 5.6% in the early 2022, but well above the Fed's inflation goal. Inflation overall remains above 2%. Now, Janet Yellen also recently said that the surging bond yields largely reflect the resilience that people are seeing in the US economy and the notion that interest rates will be higher for longer. We tend to agree with her view. In addition to the resumption of student loan repayments this month and soaring yields, the United States is also dealing with trillions of dollars of federal debt, 2 ongoing wars, and now the possibility of a government shutdown in the coming months. One theme of the American economy this year has been resilience, but that will certainly be put to the test in the coming months. At the 12th rate hike, a 12th rate hike could potentially remain on the table and be possible for December. If this is the case, you do wonder how the MPC interprets the Fed's notes and whether we may see another divided committee and perhaps even a rate hike. Well, according to Trading Economics, their forecast is that rates will remain unchanged for the remainder of this year. Our PPI also continues to trend higher, and then when looking at the PMI, or your Purchasing Manufacturing Index, we see the PMI fell to its lowest level in 12 months, and for the 8th consecutive month remained below the 50 level mark. Now, PMI is a very good indicator of what is to come in the lagging GDP numbers, and if this trend continues, then it could indicate a material slowdown in the GDP momentum. There's a slight positive note, and that is that this specific index measures expected business conditions as well, and it's positive. So it highlights that purchasing managers are not expecting that these tough conditions will persist. But how does the average South African feel? Though it depends most probably who you ask, our consumer sentiment indicator shows a slight uptick. There has been a bit of an increase in the willingness to spend. Some economists are stating that the pause in the interest rate hikes could partially be the reason for the increase in willingness to spend, as well as the fact that we've seen some relief in the amount and the extent of load shedding. Now, our macroeconomic outlook can thus be summarized by this one slide. Macroeconomics and understanding the geopolitical risks is important in our process, but so is asset class valuations. Now, the first snapshot I'm showing is a view of our valuation tool that we've built in-house for us to determine the valuations of, for instance, growth assets. Very importantly, it doesn't merely just look at your price or specifically your price earnings metrics, but rather consider various other metrics alongside these price multiples. The very left column there, you'll see the current earnings yields for the various growth asset classes. And then towards the right, you'll notice the different moving averages for your 10-year, 5-year, 2 years. Your color coding here, it's in line with how many standard deviations from the mean the asset class has moved. And this then becomes very useful as it identifies which asset classes can be deemed cheap, fair value, or then expensive. Now, we do a similar exercise for the defensive asset classes, as can be seen from this table. And again, we try and show the depths of our research to illustrate additional factors. So here you'll notice real yields. We've added real yields on here. And there's a part where we look at the relative CPI for the regions. But maybe staying on this topic of the defensive asset classes, consider what we see in the flows report. Now, this is published by 91 Monthly, and they show that foreigners are continuing to sell off bonds and local equities too. So I actually asked our analyst Viandal to compile this table for us. It shows the constant maturity bonds for various periods. So let's see, on your left-hand side, this is where you will view the constant maturity bonds for the various terms. And then there's the various scenarios which could potentially play out. So if we see a 50 bip rate cuts or rate hike, a 150 basis point move, or even then a 300 basis point move. And what this table tries to show is at which level will we potentially see no positive returns or 12-month positive returns for bonds. So this is the reason that we also show the table. So we often get questioned, what if the SARB then starts to cut rates in the second half of 2024? Now, this table shows there's only a few instances where you'll most probably not see a positive 12-month return and start seeing capital losses from your bond position. And that's most probably for your mid to longer dated bonds and also at a 300 bip increase. In all the other instances here, there's capital appreciation that you can expect from the bond market. And that's given the inverse relationship of your bond yields and your bond prices. So it does make this asset class a firm favorite among many. It's actually difficult not to like bonds at the moment. And also to consider that if you don't just consider the total return aspect, there is also the consideration that the current yield offers a level of protection depending on which area of the curve you play. Now, looking at the asset class returns over the last 1 year, 3 year, 5 year, and 7 year period, I'm actually wondering how many of us would have guessed 7 years ago that this would have been the type of convergence that we could expect from asset classes. For a moment, just consider here the 7-year return numbers for local flexible income and local equities. And your double-digit returns came actually from just holding your offshore equity, which in turn was from the rand weakness. Now, I think the better question when we look at this table is what can we expect in the next 7 years from asset classes? If you want to maybe shift the theme away from what we initially now mentioned, inflation and interest rates, then what else should we be concerned about? Most probably it could be the earnings growth of companies. It could be overall economic growth. Now, our asset class view is that we do see local flexible interest and local bonds still very much attractive. Even money market yields are giving you some real yields at this stage, and it's difficult not to see the value on offer from your local defensive asset classes. Now, in the growth space and in absolute terms, we would probably say that local equity and local property seems a little less attractive. But when you compare these relative to one another, we do prefer your local equity to local property and, in a sense, perhaps even to your DM equity. Global bonds could be a bit more of an interesting asset class. Now, US Treasury started the year at 3.5%, and now we see the latest number very close to 5%. A lot of US investors have lost substantial value in the last 18 months in the longer duration assets. However, in the local bond, local equity, and local property space, we also know that there are some structural challenges. And given that the cost of money or then interest rates have gone up, there are potential headwinds for many of these asset classes. Unfortunately, in the local equity space, there's been a handful of stocks that delivered good results, and the narrowness of the market remains a risk. The story for emerging markets also haven't been good, and the rand that has weakened has made it difficult for the SA investor. So we are cognizant about DM equity space. We see the yield curve, and it does still indicate that there might be a chance of a global recession, but potentially not as deep as we initially thought. Now, we also appreciate that many stocks have re-rated, so it does make the view a bit more neutral at this stage. I should maybe also state that we have an upcoming investment committee meeting in November where all of these views will be reassessed as the latest data then becomes available to us. Now, on this Amity process slide, we just highlight that we make 3 core decisions. We consider the asset class mix, we consider the managers that we select, and then we end up to construct the portfolio. Now, considering the asset class valuations which we just discussed, I'm pleased to report that since implementation of our outcomes-based philosophy, which also saw the start of our more robust and rigorous process, we have managed to deliver positive asset allocation across the 3 growth outcomes-based models. Manager selection has also been positive for both guarded growth and optimal growth. And steady growth has seen, as you can see from this slide, has a bit of a slight detraction from manager selection since the implementation of the outcomes-based philosophy. We also highlight the top 3 contributors for the year. And Amity BCI Diversified Income Fund, our own Global Diversified Fund, and then the Fairtree Fund was the 3 top contributors. The guarded growth and the optimal growth model portfolio, as I mentioned, had positive attribution effects for both manager selection allocations as well as our asset allocation calls. And here you also will see the top 3 managers that have contributed positively over the recent 1 year, which is in fact the same 3 managers in both instances. Now, we are often asked how portfolio construction now plays a role in our process. And I thought to maybe show you one chart. Now, this firstly showcases the skill set of our team and the benefits of our process. Now, we have this evidence-based process and scorecard methodology that helps us when we are looking at managers and how to incorporate our preferred managers. Now, what you'll see on this slide is what we are looking at is a rolling return graph of the excess returns. Now, the black solid line there is the index that we use when we consider local equity carve-out, and the index is the SWIX in this case. And then the lines around that, the rolling return lines, would then be for our steady growth, our guarded growth, and our optimal growth, as well as the balanced income in orange. But just maybe ignore the orange line for a moment. Looking at the steady growth, our guarded, and our optimal growth, you'll notice that the equity carve-outs, meaning that combination of local equity managers that we hold, have delivered some exceptional alpha. Now, using these 2 managers in combination works extremely well. Back to the balanced income, we did see some changes to the SAA, and that's why you'll maybe notice the uptick over the recent couple of months for the specific balanced income. Now, looking at our range then of our outcomes-based model portfolios, we specifically showcase the steady growth, guarded, and optimal growth on this slide. And I thought to maybe start by providing some feedback in terms of the returns by highlighting the probability of each of these outcome models achieving CPI over their rolling period. Now remember, this CPI target is the primary target that we've set out for each of the model portfolios. What you can see here is that each model has their primary target to achieve with a very high probability CPI over their respective rolling periods. But let's translate. We want to at least achieve with a 90% probability CPI over rolling 3-year periods for the steady growth model portfolio. Now, let's see what happened until end of September. This table highlights the actual probability numbers. Not only will you see that we've managed to deliver and enhance on that set or that probability numbers that we've set out in our mandate, but we also beat the CISA category averages. Probability numbers talks back to our consistency approach. But what if we just look at the capital preservation elements? Well, we have managed then in percentage terms to actually preserve the capital, as you can see, very well against inflation for all 3 strategies over their respective rolling period. This table also highlights the secondary benchmark to look at the possibility of achieving the CPI plus target for each of the model portfolios. And again, those probability numbers show that it is much more difficult for your CISA categories to actually achieve or exceed a CPI plus target. Remember that we also look at the models in terms of the 4 pillars of outcomes-based investing. Our website has the live updated numbers that will refresh monthly. And here you can see, as an example, the stable income model portfolio. It is then done phenomenally well, and it delivered on the actual rand value or the outcomes component very well. If you invested 100 rand 1 year ago, it would now be worth 109.80 rand. Compare that to what you would have earned in the CISA multi-asset income category of 108 rand or 107 rand if you invested this in the STEFI. This model also has an income focus, so you will notice the very good income distributions coming from this portfolio as well. Now, we focused on the balanced income in our income webinar, and I've just mentioned now again, we've made some changes, so we're not going to refresh or talk about that just now. You can revisit the webinar if you'd like to just view our current positioning. So let's maybe end this session with global investing. Should you take money offshore and should you invest in dollar assets right now? Now, firstly, if you do want to go this route, we do have direct global model portfolios that you can invest in. But maybe coming back to those questions. Interestingly, the period between 2000 and 2020 was divided into 2 halves. There was the first 10-year period, which wasn't such a great time for investing offshore. And then came the latter part of the 10-year period, where it yielded a much different result, and offshore investing became a firm favorite. We showed this chart also earlier this year when we discussed our income investing, and we highlighted the interesting times of the rand. Now remember that the rand is the most volatile and actually the most liquid emerging market currency. And that's why we always caution that you should not try and forecast the rand. I must say I actually appreciate Gail Daniels from 91's view on predicting where the rand will end up, because she actually has the opinion, or is of the opinion, that you could potentially predict the rand, as it will always depreciate, which when you consider this graph and where the rand is currently trading at, seems very probable. The 2 global models that we would like to draw your attention to is the global balanced and our global growth model portfolio. These models are also, like I mentioned, our direct offshore offering, and they are based in US dollar terms. But I'd like to just focus on the global growth and give you some feedback on the return numbers. Here you'll notice that if you invested your $100 7 years ago, it would be worth $158, while the EAA category only delivered $134. And the portfolio managed to achieve or exceed your SOFR plus 4% benchmark with much better consistency. So there's a rather low probability to a negative 1 year for the model, and overall in dollar terms, your 7-year annualized return would have been well ahead of what the EAA category would have delivered. How does this all then translate back to your financial plans? Does it work in financial planning to make use of outcomes-based models? Most definitely yes. Now, investing a client who has a goal or a life event to send his son to varsity in 7 years' time, he can easily use the optimal growth portfolio. And if he invests his 100,000 Rand bonus at the end of the year, it would be ideal to make use of an outcomes-based model portfolio where you can plan with a much better probability for him. If you were left to only select a combination of large balanced funds, the CISA multi-asset I equity category, you potentially have a very little probability that you will get close to your CPI plus 5%. How do you do a financial plan then for your client? Now, using this model in the voluntary investment vehicle for your client, and let's say you did start 7 years ago when he came to visit you and you wanted to invest 100,000 Rand, you could have easily, with very strong conviction, tell him that firstly, he will keep track with inflation and we won't erode his purchasing power. Given that educational studies typically increase yearly by inflation plus 1 to 2%, you would have made sure his money kept track with inflation. So not only did you preserve the capital, but you also delivered on the outcome, the actual rand and cent value, and came very close to a CPI plus 5% target. If your client felt that given that this is such a personal goal, that, will he be able to send his child to varsity? You could have assured him that Amity focuses on consistency. And we never aim to deliver such excellent consistency results at the expense of risk. Therefore, the chances of a negative one-year return is not only less than that of the CISA category, but the worst one-year number is also far less. So you are very welcome as a financial advisor to share with your clients that Amity makes financial planning easier and the investment journey much better as we make use of some exceptional managers. Our proprietary scorecards guide us in who to select, and I asked 3 of these managers to share with us their views today. So let's start this morning. Kim Silberman is joining us from Matrix Fund Managers to share with us their view on some macro indicators and also give an idea of their thinking in terms of the local bond space. Thank you so much, Kim, for joining us this morning. Over to you.
Hi, everyone. My name is Kim Silberman. I'm an economic strategist at Matrix Fund Managers. Instead of going through a full economic update, we've got 10 minutes, so I've narrowed it down to what I think is going to be the main driver for markets over the next 12 months, and that's the interest rate cycle. And what we've seen is that we've had a peak in global interest rates. If you think back to the global financial crisis, we went into a period of a historical anomaly in terms of interest rates. So you had quantitative easing. Global rates went in the US, the UK, and the EU. You had rates, if not at negative, then at zero or close to zero. So for 15 years, really an era of very cheap money. And that kind of low interest rate environment, anomalous environment, means that you've invariably had distortions in asset pricing. We had the NFTs, etc., Bitcoin, all these assets that so the search for yield inflated to sort of ridiculous rates. And so just like those bubbles burst, those were the first to burst, we're going to see more trouble, I think, on the horizon. And we saw regional banks in the US responding to higher rates and some failures there. And I don't think that's the end of that story. I think as over the next 12 to 24 months, as households and corporates have to refinance their loans, so they've got fixed rate loans that are still at very low rates, and when those need to be refinanced at these normalized rates, then I think we're going to see increased fallout, and that's going to intensify the slowdown in the US economy. Which means the Fed will have to cut interest rates, and when the Fed and the EU start to cut interest rates, then South Africa can also start to cut interest rates, and ultimately that means over the next 12 months, what we're going to see is the global interest rate cycle starting to fall. So rate cuts, we're going into a cycle of a rate cutting cycle, which is obviously very positive for bonds. At this point, when you're at the peak in the global interest rate cycle, cash is king. Cash is exceptionally attractive. And as you can see here, when you look at it in real terms, in terms of the green line there, your real 1-year money market rate, is pretty much giving you the same return as a 10-year real rate in the bond market. So on a risk-adjusted basis, you're winning with the money market rates. You're getting better return on a nominal bond, but on a risk-adjusted basis, you can't really beat cash. That will change as we go into a rate-cutting cycle. Obviously, then the money market rates will come down, and you'll see a rally in the bond markets. I just want to show you in terms of the normalization of global rates. I think these two charts probably are quite helpful. So you've had the US 10-year when you look at that, this chart goes back to 1997. So you can see here post the 2008, where interest rates really fell to historical lows, and what's happened post-COVID and the inflation that has been precipitated post-COVID, this dramatic increase in interest rates back to where they were before the crisis, i.e. that's what economists mean when they talk about normalizing interest rates. They've normalized back to the financial crisis level. So this abnormal period of exceptionally low rates and quantitative easing is now over, and we need to reevaluate the landscape. If we look, so this is nominal rates. If we look at real rates, rates that are about, this is what you're going to get before inflation. Those have also normalized. Exactly in exactly sort of the same way, and those are back to pre-crisis levels as well. So because of our structural growth problems and the rise in our debt to GDP, and the fact that we haven't managed to, so what I wanted to highlight in the previous slide was the only way out of our fiscal dead end here. The way out is not cutting expenditure. The big problem is not actually wages or the basic income growth. The big problem is that we aren't growing fast enough. And so we aren't able to spend what we need to spend as a developing country. So what you can see here, the blue line is our model of where bond yields should be, and the black line is the actual yield of the 10-year bond. And currently, our bonds are priced for the kind of risks that we face. So we've priced in this deterioration in our fiscal story. And we've also, what this also prices in is that big increase that we've seen in US Treasuries. So when US Treasuries go up, our bond yields go up. And when they come down, our bond yields will come down as well. The longer term risk here is that you can see this is that blue line is the spread. So South Africa's yields above the US Treasury yield, okay? And you can see we used to track the purple line, and the purple line is the bond yields of our peers, all the other countries that are rated BB. South Africa is rated BB, and that purple line is the average yield of all the other countries rated BB, and we've been tracking that. So we've been in line with our peers. Our yields have been the same as all the other countries that are rated like ours. But what you can see here is that as our fiscal path has deteriorated recently, our yields are starting to rise and dislocate from the purple line. Now, the fear is that this blue line is going to move in line with the maroon red line, i.e. we're going to be downgraded to a single B. So that is structurally a negative path for our bonds, but that's something that could play out over the next 5 to 10 years or 5 to 7 years if we don't start increasing our growth rate to 2-3%. So essentially, cyclically, the next year is very positive for SA bonds. Structurally, though, over the next 5 years, South African bonds should sell off over time slowly. The yields should rise if we don't get on a more sustainable path with respect to growth and our fiscal story. Thanks, everybody. Enjoy the rest of your conference.
Thank you, Kim. And just to mention again that Matrix manages our Amity BCI Diversified Income Fund. This fund is a standalone unit trust fund which you can also access and can be used as perhaps a bit of a cash alternative fund, but it's also a building block fund that we use within our model portfolios for which makes up part of our flexible interest allocation. So thanks to Kim, that was very insightful, and I think it will also now be interesting to hear from Chantal Baptiste from Fairtree, what their thinking is around some global macro indicators and the local equity market. It is always such a privilege having the team from Fairtree joining us. Fairtree is one of our preferred local equity managers that we hold in conjunction with ALIT, and the two fund managers work absolutely well together. But thank you so much, Chantal, for joining us this morning.
Hi there, my name is Chantal Baptiste. I'm one of the equity portfolio managers at Fairtree. On behalf of Fairtree, we'd like to thank Amity for including us today on this platform. I'm going to be unpacking our views on the global macro and also bringing it back into how we're positioning within the fund. This year, the global macro has been incredibly perplexing and unsynchronized. At the beginning of the year, we said to our clients that we're expecting quite a significant reopen from China and also a potential for a hard landing across the developed part of the world, most pronounced in the US. Neither of these have come through, so we've got the macro horribly wrong during the course of this year. We've seen a much softer reopen in China, with the Chinese nation facing significant confidence crisis in their own government. And on the developed part of the world, we've seen interest rates go from 0 to north of 5%, and nothing has faltered and nothing has spilt over. And we're scratching our heads and trying to understand, is it a timing issue? Or did we get the macro wrong? And even though the Fed has taken interest rates from 0 to north of 5%, nothing has really broken. In February this year, we saw the US regional banking crisis, and we thought this was the beginning of some type of issue. But then we pushed straight through, and we've seen strength upon strength coming out of the US print. We believe a key mechanism that's broken down in the developed part of the world is the mechanism for monetary policy to really impact the consumer. And the reason behind this is what we're seeing is consumers are shying away from taking on new home loans. What you're looking at here in the black is if you are a US citizen, this is your current home loan or mortgage rate that you're paying monthly. If you had to sell your home and take out a new home loan, you would be paying the orange line there, which is sitting at just shy of 8%. So you're going to be paying almost double in your monthly installments should you sell your home and take out a new home loan. What this means is that the US consumer has flooded into the rental space, and this is keeping global inflation higher for longer. Bear in mind that rental is about 44% of the US CPI basket. Our base case is that global inflation will remain higher for longer. We are still expecting some type of weakness coming through the developed part of the world. It may first come through in the Eurozone or the UK, where we're also seeing significantly higher interest rates. What the market is telling us is that interest rates have peaked, and we should start seeing cuts towards the end of this year going into next year. We believe interest rates will remain higher for longer because of higher inflation. Given the higher inflationary environment, we've tried to add some protection to the fund through hard currency assets such as gold. If we cast our eye now to China, the outset of this year, we said to our clients that we were positioning for quite a significant reopen. The Chinese nation sitting on a lot of savings, and the mechanism then for those savings to find a space in the market. The way we tried to play this reopen was through consumption and not infrastructure. So our expectation was that luxury goods, retail, as well as anything service related would do very well. Year to date, this has come through. Richemont is a stock that we have traded. We started the year with quite a significant overweight in Richemont. We then used it as a funder, possibly a little bit too early. And recently, seeing a little bit of weakness in the stock, we have added back to that exposure. The issue with China is that the data points coming out have remained very weak. China sits in a significant confidence crisis at the moment, having oscillated between regulatory environmental headwinds, as well as zero COVID policy, as well as Xi Jinping being named leader for life. We are seeing that the Chinese people are not quite sure what direction their leader and government is taking them in. So what you can see here is in the last 3 decades, one of the lowest level of confidence that we have seen. We think it will take a lot for the Chinese people to gain confidence and gain that ability to invest back into the country. We still think infrastructure will be okay and robust, and we've seen iron ore prices remain resilient during the course of this year. Our preference in the commodity space has been more for base metals, that's copper, aluminium, uranium, zinc, nickel, for example, and that's because the ESG supports in the background, as well as the completion of existing development in China. This is how we have positioned the fund during the course of this year. I wanted to illustrate how active we are as active equity managers. And what you can see is we've added a little bit more to our defensive stance because of higher global inflation, because of the potential of some type of crash across the developed part of the world. We are still trying to play the China reopen story through consumption, and that would be exposure to our consumer rand hedges. In our resource space, you can see the significant change we have made is we have reduced our PGM, platinum group metal overweight, which we started at the beginning of this year, to quite a significant underweight. We have rotated that exposure into SA Inc. We still like energy. We've seen recently the supply side response to oil, and we think the likes of Sasol as well as an oil ETF would do well in the fund. We like gold. That also speaks to our defensive rand hedge, as well as having exposure to hard currency in a time of higher inflation. We've added to paper more recently. We like Mondi, and we believe that a lot of the drag or headwinds because of their Russian exposure has diminished somewhat. We cast our eye to SA Inc. We've started to add significantly during the course of the year. You can see our preference has been for the retailers as well as the banks, and this is because they benefit from higher interest rates environments. We have not had enough exposure to the banks nor to the insurance companies, so we have had to play catch up in the insurance space. We do like our industrial companies, but they still sit within the deeper value part of the market. And recently, we've started to nibble somewhat at the property sector. Our base case is that this year we will have the worst bouts of load shedding on record. And going into 2024 and 2025, load shedding will become something of the past. And this is a combination of governments marginally improving what they have, and then more pronounced or more powerful, the private sector leaning in and self-generating. We have the likes of our mining and manufacturing capabilities that are building out significant self-generation, predominantly through renewables, which is good, but it is not like for like. And then we've also got a significant amount of work being done on the logistical sides. Transnet recently have replaced their CEO and their CFO, and we're seeing a lot more collaboration between the private sector and the public sector so as to improve infrastructure. Should this happen, should we go into a period where we have much improved infrastructure off an incredibly low base, you will see the earnings across certain sectors benefit considerably, most pronounced in the food retailers as well as some of our mining sectors, such as coal, such as iron ore, where export has been dire because of infrastructure or lack of maintenance into infrastructure. We're excited for the last part of the year. We're expecting more volatility given those huge global movements, but we are trying to position our fund as best to create alpha for our clients. Thank you so much for your time today, and all the best for the rest of the year.
So our final guest speaker is Ryan Kluser, Portfolio Manager at Catalyst. Catalyst is a specialist in the property space, and we make use of their Global Developed Market Property Fund. Ryan, I would like to pose this question, and I hope your segment can answer. Global real estate has recently faced significant challenges. What is your outlook for the sector in the foreseeable future?
Thanks, Tanya. I think in order to take a view on the outlook for global listed real estate, you really need to take a view on what has occurred over the past 18 months or so. As we know, the asset class has sold off quite significantly. In fact, it has underperformed both global equities and global bonds. If we try to unpack that, the first place to start would be the rising rate environment that we find ourselves in. As we would expect, on the back of rising rates, you would expect there to be a mathematical derating for all risk asset classes, which we duly saw. However, global listed real estate then took a further leg down and sold off even more. And there can really be only one of two reasons for that. Either it is because there's been a significant reduction in the earnings expectations for the asset class, or two, it has purely been an additional derate, i.e. the market is just prepared to pay less for for a pretty similar earnings stream. Now, having spoken to a few industry participants and reading a few articles in the media, we see that there's this perception out there that rising rates has a material and immediate impact on the earnings of global listed real estate. Now, that is not the case. Yes, it is a levered asset class, and therefore rising rates will impact earnings, but it is nowhere near the quantum that the market seems to anticipate. And there are really three reasons for that. For purposes of illustration, I'm going to refer to the US listed real estate market. It is the single biggest market in the global benchmark and comprises about 70% of the global universe, and therefore is a good proxy. If we look at US listed real estate, we can see, firstly, levels of debt are just off their 20-year lows. Okay, loan to value currently sitting at about 33%. So firstly, incredible low level of debt. Secondly, 86% of US listed real estate debt is fixed rate debt. And thirdly, it has a long weighted average maturity profile of about 7 years. So you put that all together, you have low levels of debt, majority of which is fixed, and its long duration. And that means it is really only when those debt instruments either expire and need to be refinanced at higher rates, or when companies issue new debt to fund acquisitions and developments and the like, it is only then that the impact of these rising rates is actually felt in the income statement and on the earnings stream. Okay. Now that is significantly different to the perception out there that there's this immediate mark-to-market of debt costs overnight. It's also worth pausing and contrasting what we see in the public market real estate that we invest in versus what you see in the private market real estate. In the private market, there are many participants which have north of 70% loan to value, and the majority of their debt becoming due in the next 12 to 18 months. Now, those entities are absolutely in trouble. They are going to have to either inject equity into their structures, or they are going to have to sell assets, likely at distressed valuations. That is in stark contrast to what we see in the listed real estate environment in which we invest. So if we circle back to our original question, which was, has the sell-off been because of earnings reduction or because of a derate? I think it is safe to say that it is not because of a significant earnings reduction, and therefore as a consequence has to predominantly be because of an enormous derate, i.e. the market is prepared to pay less for a very similar earnings stream. If we look at the S&P 500, we can see that listed real estate has derated significantly since the start of 2022, and in fact is the sector which has derated the most over that period. Now that we've assessed what has occurred in the recent past, let's turn our attention to the outlook going forward. The best place to start would be the earnings profile for global listed real estate, because it is earnings that is going to drive total shareholder return the most over time and through the cycle, even though that has not been the case in the recent past. Earnings are driven by underlying real estate fundamentals, things like supply and demand dynamics. When we look across our global universe, it is worth noting that the majority of sectors have incredibly good underlying real estate fundamentals behind them. There are one or two exceptions, things like offices, which we all know are facing some headwinds at the moment. But by and large, most sectors have incredibly good supply-demand fundamentals behind them. In addition to having robust underlying fundamentals which will drive earnings growth, we think something that's probably quite underappreciated by the market is the fact that many of these sectors have incredibly strong secular demand drivers behind them, i.e. things which are relatively independent of general economic growth. For example, something like the single-family rental sector. The demand driver behind this sector is really an aging millennial population, i.e. a demographic tailwind. Or something like the towers sector, where the demand driver behind that is really an ever-increasing consumption of data, together with mobile network operators rolling out their 5G networks across the globe. Now, those demand drivers are not dependent on there being general economic growth, i.e. if the US were to go into a sort of a short and shallow recession, it is very unlikely that that would disrupt those strong structural secular demand drivers that we have just spoken about. What that results in is an incredibly robust and resilient earnings stream in the global listed real estate sector. In fact, the range of outcomes between a hard economic landing and a soft economic landing, a bull market and a bear market, is a lot narrower than what you're going to see in many other general equities subsectors. And that gives certainty and resilience to the earnings stream, which will underpin total shareholder return. So we have robust earnings growth, which underpins a very robust dividend yield. To put it into context, global listed real estate is giving you about a 4.7% forward dividend yield in dollar terms at the moment, and growth over the sort of intermediate term is at a pretty similar level. Now that gets you to a total shareholder return in the high single digits in US dollars. And that's before we consider the third variable of our total shareholder return equation, and that is a re-rating or a de-rating. Now, as we ascertained earlier, there's been an enormous de-rating in global listed real estate over the past 18 months. And therefore, you would expect at some point in time there to be a re-rating of the asset class. Now, I'm not smart enough to tell you exactly when that re-rating will occur. However, a few things are worth noting. If we look at prior hiking cycles and mini hiking cycles, we notice that US listed real estate underperformed US equities at the start of these hiking cycles. However, the 6 months post the end of the hiking cycle, US listed real estate outperformed US equities quite significantly. And therefore, not to say that the past is going to repeat itself, but a likely catalyst for a re-rating here would be us reaching the end of the current hiking cycle. Now, without trying to call the top of the hiking cycle, I think what we can all agree on is that we are approaching it and we are very near the end of it. And therefore, in the foreseeable future, we are likely to potentially get this positive re-rating in the global listed real estate asset class. Another factor to consider would be potential fund flows into the asset class. As we can see, US listed real estate is the most under-owned subsector by both long-only and hedge fund investors. And therefore, one would expect that when these investors start to reduce their underweights and potentially go to a more neutral weight in the subsector, those fund flows could likely catalyze a potential re-rating. So to sum it all up, global listed real estate has had an enormous de-rating over the past 18 months. Going forward, the sector has an incredibly robust earnings stream underpinned by incredibly strong real estate fundamentals, many of which are independent of general economic growth. That results in an earnings stream which is quite predictable even under various economic environments. Furthermore, this earnings stream underpins a very robust and healthy dividend yield. Those two together provide shareholders with incredibly attractive total shareholder return. However, in addition to that, investors are likely to also get a potential re-rating of the asset class at some point in time, which would really serve as a sweetener on top of an already attractive total shareholder return profile. Considering that, we think this is an asset class which warrants consideration by investors at this point in time. Thank you very much.
Thank you so much, Ryan, for sharing that. Ladies and gentlemen, that's the end of our webinar this morning, and I'd like to thank all of you who attended this morning. The recording of this session will be available on our YouTube channel. Please feel free to reach out and get in touch with us if you have any questions on what we've discussed here today. And then we look forward to also hosting you in our upcoming webinar, A Morning of Ethics. It's on the 16th of November, so be sure to register for this webinar too. If you struggle to find the link for registration, just view our LinkedIn page where we've also made this link available. Thank you again for watching. Have a great day. Goodbye.